to welcome you to the Naira Playbook webinar, and we're thrilled to have you here for this important discussion on strategies for investors, businesses, and policymakers. My name is Bisola Amuda, and I'm the head of human resources at Codros, and I'm honored to be your moderator for this session. So as we begin, I want us to warm up the chat box. You can let us know where you're joining us from today. Feel free to introduce yourself. Your next network might be from this webinar or in the chat box. So please drop your name, your location. We want this to be as interactive as possible. And that's because also throughout this webinar, at random times, I'll be spotlighting your comments or your name. I can see Emeka Modi joining us from Lagos. Thank you so much for joining us today. Please keep the comments coming, keep your location coming. I can see Adeyemi joining us from Lagos as well. Welcome, Adeyemi. Oh, okay. So Onome is also joining us from Lagos. Do we have anybody from outside Lagos here joining us? Dr. Abba joined us from Houston. Amazing. Daniel joined us from Abuja. Thank you all so much for joining. Immaculata is also joining from Abuja. Please keep the comments coming. Daniel from Lagos, Bridges from Lagos. Victoria is also from Abuja. Okay, I think we have a lot of Abuja and Lagos in the house today. Thank you so much for joining. Feel free to also send the link to somebody that you think will find this session very informative. So today's webinar will provide us with key insights on how we can build. I could say for free that this session will be worth your while. I can see Ndubweze from Germany. Okay. Shekwanga is joining us from Kaduna. Okay, I think we're happy with joining from all over the world. We have Azu joining us from Abuja as well. Ido from Lagos. Thank you all so much for joining. Please keep the comments coming. So to officially kick off, let me introduce our distinguished speaker. First up is Adegbola Aino, who is the Managing Director for Codros Asset Management. Now, Bolao is an expert, an investment expert, I beg your pardon, with 17 plus years in portfolio management, investment research, and corporate finance. He has led multi-million-dollar asset strategies across various markets. Next up, I will also introduce our second speaker, who is Charlie Berg. He's the Director of Trading for Vito. And Charlie is an FX trader, I beg your pardon, that specializes in Africa currency markets, treasury, and risk management. With experience in both developed and emerging markets, he understands how to navigate volatility and seize opportunities. So you can see that we brought in the expert and the best in the game. Our next speaker for today is Arnold Dublin Green, is the Chief Investment Officer at Codros Asset Management. Arnold has 16 plus years of experience in capital markets, securities, and derivatives trading, spanning Africa and Europe. He has managed multi-asset portfolios and trading desks across major financial institutions. As you can see, we have a very exciting lineup ahead. Just to give you a summary of what we'll be talking about today. First up, we hear from Adegbola, who will give us an overview on the FX markets in Nigeria, as well as the topic of discussion. It will be followed closely by a keynote address from Charlie Bird, and then we'll delve into a panel discussion on the Naira Playbook, strategies for investors, businesses, and policymakers. Then after that, of course, we allow the audience to ask their questions. So like I said, feel free to drop your questions either in the chat box or in the Q&A box. We have somebody on the team looking up for these questions, and we'll get to answer them at the end of this webinar. I just saw that Ernest is also joining us from UK. Thank you so much, Ernest, for joining. I just see different people that are currently on the call. I see Hamed, I see Amos, I see Andy, I see Bayo, I see Benson. I mean, a whole lot of us that wants to gain a whole lot of knowledge from what promises to be an informative, packed session. Now, so further, without any further ado, please join me in giving a virtual applause. Yes, you can use the applause emoji or drop the clapping emoji in the chat box and welcome the MD of Codros Asset Management, Adegbola Aino, as it speaks to us on the overview of the FX market in Nigeria, as well as our topic of discussion for today. Adegbola, the floor is yours.
Good afternoon.
Good afternoon.
Okay, welcome everybody to our webinar. And I can assure you that it's going to be a fun-filled time. Yeah, we have like an exciting panel of speakers, market people, and we're just here to just provide some solution, just have conversation on the currency. Over time, we always have a lot of our clients, investors really want to know the direction of the Naira, even though it's quite difficult to predict the direction of the Naira, but we're able to just provide some guide based on the trend that we've seen in recent time. Okay. So I just want to set context to what we're going to be discussing today. And once I'm done, I'll invite Charlie to just give us overview and trend of what he's seeing. He works with Vettel, and of course, I see a lot of the flows. But in 2025, where do we see? We think in the US, growth might dwindle a bit. We expect to see some growth in the EU market. For China, we expect to see decline in growth. Especially we are targeting about 4.5% growth in GDP from 4.8%. For India, 6.5 growth in GDP from 7%. For the sub-Saharan African market, we expect to see improved growth. And I'll speak to Nigeria very, very briefly. While for Brazil, we expect to see decline in GDP. So across the globe, we expect to see some marginal decline in GDP on a year-on-year basis, even though we expect to see some marginal growth in Africa. I want to take you through this slide, and this is very important to see how the Naira has evolved over time to set context. And I'm going back to 1986 to 1993. Then General Ibrahim Babangida was the head of state. And interestingly, the Naira was 90 kobo to about $1 in 1970. And it was then that we introduced the second tier market. In 1993, the BDC market was introduced into the market. So I'm taking us through a journey to see how things have evolved over time. 1999 to 2004, a lot of us remember that. That was when President Olusegun Obasanjo became the president, and Joseph Sanusi was the CBN governor. Important thing that was introduced in the market was the interbank foreign exchange market, the IFM, and the exchange rate at that time was about 144 naira to $1. Remember, in 1970, it was 90 kobo to $1. Going to 2009 to 2014, when we had President Goodluck as the president, the exchange rate back then, parallel market was 187 naira to $1, while the official market was 183 naira to $1. So even though there was some difference, but was really pretty much close in terms of the spread between the parallel and the official markets. Just to also mention, sorry, in 2004 to 2009 as well, when President Olusegun Obasanjo was the president, that was when we had Chukwuma Soludo as the governor of the CBN. I think key things that we can note from that price that we saw oil price move from about $30 per barrel to $140 per barrel. So really, that was good for the economy. Excess crude oil account was at $20 billion, which was impressive. And we saw an appreciation in the Naira against the dollar, again 20%, whooping 20%. We had reserves as high as $62 billion. We've not seen those sort of high reserves in a while. But very recently, just to touch on General Buhari and now President Bola Tinubu, a lot of us can remember from 2015 to 2013, we began to see some volatility and massive depreciation in the currency. But the good thing that was introduced back then by the Godwin Emefiele was president of CBN then was the investor and exporter window there and hiding window. And some of the things that were also introduced was the buying of for three items, even though a lot of people thought that it also distorted the official rate and the parallel rates. But back then, the official rate was 148 naira to $1, but it moved or depreciated to 305 naira to $1, while the parallel rate moved from 160 naira to $1 and 361 to $1. But by the time that Buhari left later, by 2023, we have seen rates depreciate to as high as 600 over 600 to $1 in the parallel rate. And of course, President Tinubu came in 2023, and he wanted to sort of unify the exchange rate because the discrepancy was huge. Discrepancy in some regard could be as much as 15 naira between the parallel rate and the official rates. What that created was arbitrage opportunity. What that created was that we're not seeing flows into the official market because people rather take flows to the parallel markets. But coming in, we wanted to unify the exchange rates. And some of the key things that were done within that time was one, they cleared the backlog that was in the markets, which was a lot. So all the FX backlog had been cleared. Even the official rates moved from 461 to 770 in trying to liberalize the exchange rates. And of course, a lot of the policies, even though benefit of hindsight might say they're good policies, but in terms of implementation, also saw the rates move sporadically, depreciating to almost about 1,800 to Naira to a dollar. But in recent time, we've seen a bit of stability in the exchange rate. Naira appreciated significantly last year before it started to depreciate again. But now the gap between the official rates and the parallel rates has more or less been closed. In some regard, it can be as low as 10 naira, 15 naira. And this coming from a place where the disparity was as high as 100 naira, 150 naira. And I know you'll be asking me that how does this affect a lot of the things I do? Nigeria, we are highly import dependent. I remember talking to somebody recently and he said he can remember buying a Prado for I think about 3 million several years ago. And you can bet how much I want to buy a Prado now, several hundreds of millions of naira. It affects people that have to school abroad, it affects medical bills, it affects oil prices. And so it's important to be able to have a grasp of Naira. It affects investments because really when you adjust your investment to USD, more or less you are in a negative. And we thought, okay, let's have this conversation, this important conversation that everybody really wants to know about. And I just thought to give context. But good enough, where we are at the moment, we've seen some stability in the exchange, like I said. It's been trading between 1.5 to about 150 in recent time. We've seen external reserves strengthening, even though we've seen some decline in recent time. But external reserve can support well over 12 months of import cover, currently over 35 billion USD for external reserve. We've seen NPL at high rates, and really that attracted a lot of the FPIs and a lot of the inflows that we've seen that stabilized the Naira. But going forward, we saw a readjustment of the inflation rates earlier this year. And what that meant was that we saw um, yields in a lot of the market begin to come down, treasury bill rates came down, bond yields came down, even though the interest rates or the NPL hasn't been reduced. And so this just to put context, and I'll stop here so I can allow Charlie to take this presentation. After Charlie's presentation, we'll go into a panel discussion, and of course, we'll take questions from the audience. So thank you, everybody, and I'll hand over to Charlie.
Yeah, thank you, GB. Hopefully everyone can hear me. So firstly, a massive thank you to the Codros team for inviting me to speak on this webinar to your clients, investors. So my name is Charlie Bird. I'm the Director of FX Trading here at Verto. So just for a bit of background, Verto is a cross-border payments platform for businesses. It's purely B2B businesses. So we speak to a lot of corporates, both in country and externally across multiple different markets, and not just Nigeria, but other frontier markets such as Kenya, Tanzania, across the ZAF and ZOF regions, and even outside of Africa as well. Our speciality arguably probably is Nigeria. Our two co-founders are both from Nigerian descent, so that is probably the market where we see the most FX volume, but we cover a lot of African markets and sort of understand the dynamics pretty well. Across this presentation, there's going to be some bits which may be fairly obvious to those who are based locally, and there will be some overlap with some of what GB has just articulated with some of his slides. But I'm sort of going to come from it from a corporate perspective when it comes to FX, like the ability to source dollars, etc., how that's evolved over time. Then obviously with some overlap into more of the institutional space. So we speak to a lot of foreign banks, institutional banks, as well as hedge funds and pension funds. So I can give you their sort of perspective and appetite of the macroeconomic picture in Nigeria, and particularly those who are either already invested or looking to invest in the future in Nigeria. I can sort of give you a flavor of where their mind is at the moment, what they're looking for in the future, if they want to look at investing more in Nigeria. And obviously that would involve bringing dollars in country to either turn into Naira to pick up local currency based investments, or whether they're looking for things like Eurobonds, etc. So just looking back, I know GB was looking back over the last few administrations, but if we're sort of focusing on the most recent administration with Tinubu coming in, President Tinubu, so we know there was an immediate devaluation post his administration quite soon after, because for years there had been this pent-up demand for dollar liquidity in country, and clearly that was putting a lot of stress on the pegged exchange rate. So something clearly had to give, and this is one of the big moves that he made. And that initial move to the high 700s in the official market was met with quite a lot of enthusiasm, because at the time this matched roughly where the parallel market was trading. So if we look at the chart I've got here, I've just pinched the official rate, if you like, is the BGM rate off Bloomberg, and then I've overlaid with the white box roughly where the parallel market's been trading since that initial devaluation by President Tinubu, and obviously Governor Cardoso coming in at the CBN. So the idea clearly here was to try and make the official market a more willing buyer, willing seller model. This was the thing that was being pushed quite heavily, and trying to remove a lot of the restrictions within the official market, and to ideally reduce the spread between where the parallel market was trading the official market. The parallel market, arguably, for the time being, is always going to exist, and we'll discuss that in a later slide. But what we saw over time, as the official market towards the end of 2023 was held at around that high 700, low 800 levels, the parallel market was depreciating down day. There was still a lack of dollar liquidity within the official market, and that caused a lot of corporates, especially, to come over to the parallel market to try and source their dollars. Now, the CBN obviously tried to remedy this with various interventions by injecting dollar liquidity via the BDCs or local banks into the official market to try and mop up the demand. But clearly, it was surplus. There literally was not enough dollars to go around. There was numerous instances of for example, airlines who are accruing profits in country and were unable to source the dollars to then move out back to their wherever they're based, whether that be Europe or the US or the UK. So there was this continual demand for dollars that just couldn't be facilitated. So as the parallel market clearly depreciated quite aggressively in early 2024, the official market had to follow in some way, and that's kind of what we've seen. Over the last 12 months, I mean, there's still been a spread between the parallel and the official market. We've seen at times, and we'll zoom in over the last 3 months to see what the recent dynamic is. But we've seen that spread converge to zero at times. A lot of these instances of, for example, these airlines with profit repatriation issues, arguably this backlog or this heightened demand for dollars is definitely eased. And we've seen more dollar liquidity in market more recently, but we'll discuss that on a later slide. So with the, as GB mentioned, when the devaluation happened, one of the big moves that was made was to condense all the various different FX windows into one. So arguably, it's not uncommon in certain emerging markets to have multiple different official windows. Venezuela, for one, must have 20 different or 25 different FX windows at the moment, depending on the type of individual, type of corporate you are. Like, it's not an uncommon thing, but if you want a fluid, fully functioning FX market officially, then really you need to start eradicating these windows. So this is where the INE window, which is now called the NAFEM window, was born. Now, to participate in this market, you require documentation to be granted to you by your local bank via a Form M, A, or Q, depending on what product you're looking to fund when you're looking to source dollar liquidity. Now, GB mentioned the list of 43 items. So this was quite a heavy restriction on a lot of corporates so that they couldn't access the official market. It's not been publicly announced, but this 43 item list is it's sort of been parked a little bit, but there's still quite a few corporates who still cannot access NAFEM liquidity, and this means that they eventually have to come over to some sort of parallel market and to source their dollars. So this is still a slight issue that's going on at the moment within NAFEM, although this is miles away from where we were 1 to 2 years ago. And the other slight issue with the Form A, Form M, Form Q situation, as far as we're concerned, is it takes some time to get these forms in place. It can take 1 to 2 weeks. And especially when we've seen the volatility in the Nigerian Naira, which arguably has been lessened over the last maybe month or two, but we have seen some pretty big swings. I mean, 5% moves in one day in both the official and the parallel market isn't completely unheard of at the moment. So if you're a corporate and you need to source dollar liquidity relatively quickly to either settle an invoice or rebalance your books, these 2-week lead times in order to get a Form A or Form Q to access dollar liquidity in the official market becomes pretty unpalatable, because you've got 2 weeks where volatility could occur and you can't plan how many dollars you're going to have on your account. So that too has led to the parallel market remaining in existence alongside the official, even though dollar liquidity at the moment is quite strong in the parallel market. In the official market. The next move that the CBN did, this was about 6 months ago or just under, was the introduction of the electronic FX matching system. So it's called EFEMS. So essentially what the CBN decided to do, or the government decided to do, was to move the official market into an electronic order book. And they're using Bloomberg BMatch as the platform in order to leverage this. So on the right-hand side, you can see the current order book at the moment. This is as of this morning for the NAFEM window. Now, in theory, it should work. Like, in theory, there should be a really rich, deep order book here of buy and sell orders. And you look at this, you think, well, the top quote, there's a 1 Naira spread at the moment in the official market on BMatch. So clearly something is going the right way. There's good liquidity on either side. The only slight issue here is that a lot of the local banks are continuing to quote away from BMatch. So historically, before this electronic matching system came in, you would speak to your local bank in order to get a quote for dollars or equivalently for Naira in the official market. The idea of this electronic system was to, in theory, circumvent that, but unfortunately at the moment that still happens. Still have local banks quoting their own two-way prices away from where BMatch is pricing. Sometimes it's in line, sometimes it can be 5 or 10 Naira away. The issue, though, with this is that it's made the BMatch order book relatively thin. Now, we saw a couple of weeks ago, there was what we would call a fat finger trade, where someone accidentally put a buy order in 100 Naira higher than what they'd actually intended to, and it wiped out the order book. The official market, as far as BMatch was concerned, jumped by 100 Naira, and then it took some time to come back. And because the order book wasn't that deep, it's not really ever recovered, even from that one trade. So there's still work to be done here. This is really positive progress, we think, in terms of visibility and transparency of the FX market officially, which is what the CBN have been pushing for some time. But there's still, we believe, some steps to be made to make this a fully functioning willing buyer, willing seller model. Now, more recently, if we zoom in on that chart that I showed earlier, and we just look over the last 6 months, especially since this BMatch system came into play, we've seen periods where the spread between the official market and the parallel market has actually gone to zero and even gone quote unquote negative. Now, fundamentally, nothing has changed in terms of who can access the market. We still have the same challenges, as I mentioned, with generating Form A's and Form M's. You still have sometimes the same challenges of like the time it takes to get those in the first place, or whether you can actually get them at all. However, dollar liquidity in the official market in NAFEM has been really quite good over the last 6 months. There's been very few occasions where you wouldn't be able to ring up your local bank and source $5 million or $10 million at a time. Now, this dollar liquidity, in our mind, slowly but surely filtered into the parallel market. It's very difficult to arbitrage the two markets and get away with it. There's not many people even trying, let alone succeeding to do that. However, just by course of dollars circulating between hands, 10, 20, times on the ground. At some point, those dollars have been filtering back into the parallel market. And in late February this year, we saw pretty much a zero spread between the two markets. Now, this is still like opened up a little bit, but it's great news for the CBN. They've kind of stated that unification of the two markets isn't necessarily a goal. There was a lot of questions asked of Governor Cardozo about unification, and he very much pointed to, actually, we just want the spread to be zero or near zero. Back at the end of 2024, when the spread was 8 to 10%, that was pretty unpalatable. But now that it's back to that 0 to 2% level, this should keep some positivity among the CBN as they look forward as to how they're going to develop their monetary policy and obviously fiscal reform as well. So I know GB mentioned about inflation, and clearly it's something that we track quite closely as well, and I'm sure it's something that we'll discuss a bit more as we move into the panel discussion. But the pressure on the currency for some time, and the reason why dollars clearly have been in high demand for years and years, is this elevated inflationary environment. For many years, the CBN weren't using an inflation targeting strategy, so base rate was relatively unchanged across 2021 and the start of 2022. But certainly since Governor Cardozo came in, they've made it clear that creating a positive real interest rate environment is a key goal for them. Now, the rebasing of CPI that happened earlier this year caused perhaps some slight confusion. For those who weren't aware, there was the basket of goods and services that we used to calculate where inflation's tracking in Nigeria was fairly fundamentally overhauled. Like food was removed, or at least a big chunk of the contribution from food inflation was removed from the headline. There were also things like black and white TVs that were removed from the basket of goods. It was quite an outdated basket, admittedly, but we did see this snap drop in inflation, and it's since like printed lower again. And clearly, with bank rate currently at 27.5%, it's led to this quite attractive, at least on paper, positive real interest rate environment for foreign investors to look investing in, because clearly they want that carry, they want the yield, and if there's confidence that the bank rate is going to stay high, inflation is going to drop, it's a good news story for those hedge funds and pension funds who are looking to invest in Nigeria and generate a real return over time. As we look forward, however, and again, this is something that we may discuss, but there may be political pressures soon to start cutting rates. Clearly, having a high interest rate environment domestically isn't really that palatable, and at some point, something's got to give. Now, what are the blockers to cutting rates, particularly from an economic point of view? Is we're looking a lot at oil prices. I mean, it's no secret that Nigeria is incredibly sensitive to the oil price, and when we saw the drop in January from nearly $80 on the first future down to the sort of just above the mid 60s in March, this clearly had quite a big investors to invest in Nigeria. So we've seen a lot of hedge funds, pension funds, and local banks, foreign banks, looking to buy into the OMO and NTB auctions. So NTB being Nigeria Treasury Bill, and OMO being the open market operations. So these are Treasury bills, but they're issued by the CBN rather than the government. And the yields, or the discounted yields on those, have been pretty strong. They've been over 20% for some time over the last few auctions. However, we've seen a couple of auctions recently come in below 20%. And this didn't necessarily spook foreign investors, but certainly those who were slightly late to the party and didn't buy into the OMOs late last year or earlier this year, they were very quick to unwind their positions in the secondary market. That's certainly the messaging that we kept getting. And that was having an impact on the FX market. And the question I was asking is like, well, if inflation is dropping, like, why didn't you just keep buying into the yields, even if they are slightly lower? And the message came back more and more was, well, we're concerned about the oil price. If the oil price was at 75.80 on the first future, then they'd be grabbing these yields at 19, 20% quite happily. But with oil floundering in the 60s, there was some concern that well, is this going to be a long-term negative for Nigeria? Maybe I should just cut my losses and remove my OMO or NTB position. OMOs currently are the flavor of the day because they give an extra 2% or so on the yield. The other thing, as well as a lot of foreign investors are pretty hyper cognizant of, is foreign reserve data. So I think GB had a slide a minute ago, but reserve data is down, at least on paper, to I think it's $38 billion at the moment from a high of over 40 billion. Lots of people clearly suggesting this is the CBN using some of their reserves to intervene in the market and continue to supply good dollar liquidity. And that seems to be a reasonable assumption. But if we start seeing a long-term drop in reserve data, this is something that hedge funds in particular are looking at pretty strongly. And any negative signs from foreign reserve data might cause an unwind of these positions that they hold locally. So finally, looking forward, I guess I've already kind of touched upon this, but when we're looking at whether there's going to be good foreign investment into Nigeria long term, it's totally achievable. And the FX rate coming down long term, both in the official and the parallel market, is 100% a feasible scenario. So going back to 1,400, 1,300, I don't know, maybe 1,000 in the future. But there's a lot of things a lot of factors that need to play out in order for that to happen. So clearly we've mentioned oil. Clearly we need more dollars continuing to be available in the official market to keep the spread tight to the parallel market. We need that foreign reserve data to recover a little bit. We need to keep the volatility down in the FX market. This rate cutting cycle is going to be quite a big balance versus the political dynamic on the ground. If they can delay that rate cutting cycle whilst not getting any backlash, then that's going to be a positive in the eyes of many foreign investors. We still need more of these OMOs and NTBs to be issued. They tend to have a tenor of 6 or 12 months, so clearly there's quite a lot of maturity and roll off. So when there is a big maturity date of an OMO from 12 months ago, if the CBN are actively replenishing these OMOs, it might send a slight negative sign to a lot of foreign investors. So that sort of auction calendar needs to be kept up as much as possible. And yeah, there's going to be fiscal adjustments in the future. We've seen a bill being passed recently. Clearly, they need to do some moves to either generate income domestically, or if there ever was an approach to the IMF, they need to obviously put on quite a good show from a fiscal standpoint. So having that stable political dynamic, even among any sort of fiscal adjustments, is going to be pretty important. And finally, I've just mentioned here, there's always lots of questions around President Trump and other big global leaders, like the tariffs that are going on between various different nations globally. Now, Nigeria is in a relatively fortunate position in our mind, and many frontier nations fall into this bracket of being quite insulated, at least directly, from a lot of these moves in developed markets in the US. Clearly, if there's a big impact on the oil price, then it will have an impact on Nigeria directly. And there's a lot of flows coming in still from China, a lot of dollar flows coming from there. So if for whatever reason the Chinese economy decides to be a bit more self-generating and not deploying investment outside of China, Nigeria clearly could be a casualty of that if that decision is being made by a fraction between the US and China. But at least in the short term, we believe it's a fairly insulated scenario, probably for the next 6 to 12 months. So I'll hand it back over to GB and Bazola if they want to open up a panel or Q&A session. I'll stop sharing my screen. Thank you, everyone.
Right, thank you so much, Charlie, for that insightful and data-driven breakdown of the Nigeria's evolving FX landscape, our investment climate, as well as the economic outlook. You have expertly unpacked the intricacies of the liquidity dynamics, the role of NAFEM, our inflation control, as well as the foreign investor sentiment. So thank you so much. And from what you said, I think it's clear that while there are challenges, there's also immense potential for growth and stability in the long run. So please let's give Charlie a virtual applause. Please let's appreciate him for that very insightful keynote presentation. Just to spotlight a bit more people as we proceed into this discussion, I can see that we have Hassan on the call, we have Solomon, we have Steve, we have Timmy Tope. Thank you all so much for joining us today. You could be anywhere, but you decide to be here and gain more knowledge on, the strategies for investors, business, and policymakers. So now we'll dive into the art of today's discussion with our panelists. Our esteemed speakers will be diving deeper into the Nigerian playbook, which will speak about the strategies for investors, businesses, and policymakers. So at this point, I would like to invite Adegbola Aino, Arnold Dublin Green, and Charlie Bird again to join me as we unpack these strategies that businesses and investors can adopt to stay ahead. All right, so we'll get started. And GB, I think I'll just start off with you by asking you just a question. Why would you say the parallel markets for US emerge in Nigeria?
Yeah, thank
You
you,
please confirm you heard me? Oh, okay.
Yeah,
All
I
right,
did.
thank
Can you
you.
guys hear me?
Yes, we can.
Okay, great. Yeah, I think that's a very good question. And I'm sure a lot of people will be wondering why there is a parallel market. But I think it's a confluence of factors, a combination of factors. And it has to do with economic factors, some government policies, market imbalances, and I think Charlie mentioned quite a number of them when he was presenting. And over time, the CBN, who is in charge of controlling FX in the country, sometimes there have been some restriction because of the scarcity. And usually when there's a restriction, you see people creating other markets, parallel market, black market, to be able to source for currency, and that creates a parallel market. Also, Nigeria's earnings or revenues really pegged to oil price because really most of our earnings are oil denominated. Usually when there is volatility in oil price, usually low oil prices means that revenue, which we earn in dollar, isn't a lot. And that means the government really cannot afford to provide effects to everybody that needs, even though there might be genuine people that need effects. So that sort of limitation also creates avenue for having a parallel market. Also scarcity as well. CBN has limited ammunition, limited reserves to be able to provide currency for everybody, and sometimes pull resort to autonomous sources, either from maybe people abroad or the Aboki, just another market to be able to source for their USD. And of course, inflation. Nigeria is being plagued with heightened inflation over time, which of course, inflation is the rising cost of goods and services. And that means that people want to sort of protect their returns or have an edge in terms of an inflation edge. And what they do is that they look for a stable currency. And over time, USD has proven to be a stable currency over almost every other currency. So in order to preserve the value of their assets, preserve the value of their investments, preserve the value of their holdings, they tend to want to keep currency or USD. And that sort of creates a demand. So that demand as well has to go to another market apart from the official markets, which of course is the parallel market. I think another thing we've seen is that people just speculating on currency. And we saw that a lot from 2015 to about 2023 because people had lost confidence or faith in the Naira and were looking for a stronger currency to protect their earnings. So almost everybody was speculating on the currency. Charlie mentioned about some manufacturers that have demands, which really is not even speculation, but they're not able to get from the official market. They have to resort to other markets. So it's a confluence of factors, and it has to do with economic factors, like I've mentioned, imbalances in the exchange rates, and of course, inflation as well has affected it, and sometimes a lot of government restriction. I think Charlie also mentioned that they had banned some items. The 41 ban item, there was something that was quite popular. And those people that used to produce those items definitely need to resort to other markets, other sources to be able to source USD for what they need. Yeah, so in terms of why there has been a problem, because those are some of the things that contributed to we having a problem market.
All right, thank you so much, Juby. I think you've done enough justice to the question. So, Charlie, I'll come to you next. And my question to you is, what would you say is your 2025 outlook and year end when it comes to USD and Naira?
Um, like I sort of said at the end of my presentation, there's quite a few factors that would need to fall into place in order for the FX rate to necessarily, or for the Naira to appreciate aggressively for the rest of 2025. It's definitely it's definitely a possibility that it could happen, and we could see these much lower dollar Naira rates later in the year. It's I mean, like I said in the presentation as well, like a lot of these foreign investors who've been quite enthusiastic about places like Argentina and Egypt, like at the moment, those sort of trades, those longer term trades they've sort of got the bang for their buck. And now a lot of these institutions are looking for the next big place to either earn the carry or obviously make a speculative bet, if you like, on a certain economy. And Nigeria is no doubt anecdotally is number one at the moment. So there is a hell of a lot of enthusiasm to bring dollars in country, investing in this local paper like OMOs, etc. I mean, if the oil price goes down to $40, then it's going to be a real struggle for the FX rate to stay where it is. I mean, but that we're talking like a tail risk there. If we look back 18 months ago, the FX dynamic generally is it's so different from where it is now. It's so much better functioning now than it ever has been, and clearly there's still some developments or some changes that need to be done, certainly in my mind, in my opinion. But a lot of the decisions that have been made by Governor Cardoso and President Suba since he came in may have had some short-term pain, at least initially. But the long-term picture is there's no doubt it's better than it was 18 months ago. So I personally am extremely optimistic. I'm well aware of these like tail risks, like crude prices, but in my mind, I'd like to see some appreciation. I would never say we're going to just go back to where we were at 700 or 460 before the end of the year. I think that's particularly unrealistic. But considering the last 18 months have seen a lot of depreciation and a lot of volatility, I'd like to think that's at least plateauing in the short term, and with the prospect of a blue sky scenario of seeing some good appreciation through the rest of the year.
All right, thank you so much, Charlie. As we proceed, I would like to remind us that you can drop your questions in our Q&A box, and at the end of this conversation, we'll get our panelists to answer the questions. So please feel free to make use of the Q&A box, as you can see on your screen. Thank you so much. So Arnold, I'll come to you next. What role can USD-based mutual funds or Eurobond funds play in managing FX risk? Arnold, are you there? I'm not sure if you got the question.
Hi, sorry, Priscilla, I was muted. Can you ask the question again?
Can you hear me?
Yeah, I can hear you now.
Oh, yes, I was asking you that what role would you say, or can the USD-based mutual funds or Eurobonds funds play in managing the FS risk?
Okay, I mean, it's quite simple and it's in the name. So the preserved value in USD, shielding you from any Naira depreciation. A lot of mutual funds or dollar mutual funds or Eurobond funds that provide steady income through dollar-denominated coupons. So you hold Eurobonds, mainly Eurobonds in sub-Saharan Africa, African countries on the continent. They can also give you offshore exposure without local Nigerians needing a domiciliary account, and offer liquidity and diversification amongst different countries. So what you find is Eurobond funds, especially our Eurobond funds, not only hold maybe Naira exposure, where you can have exposure to Kenya, Eurobonds, you can have exposure to Egypt and different countries. So it allows that hedge or diversification across different countries. So regardless of what Nigeria might be going through or what dollar pressures Nigeria might be going through, you can have a Kenya, for example, that is almost the exact opposite in terms of oil exposure or dollar exposure or not dollar exposure per se, but local commodity exposure. So that liquidity and diversification comes from investing in Eurobond funds.
All right, great. Thank you so much, Arnold. GB, so I'll come back to you. I want us to talk a bit on CBN, right? So what could pressure the CBN to begin cutting rates? What would you say could pressure them?
Okay. Well, quite a number of things could make them begin to cut rates. Even though I don't think we are there yet, I think it might be premature to start the cut rates, but certain factors might make them to begin to cut rates. One is inflation. If inflation comes lower than what it is, that might make them to begin to consider cutting rates, even though inflation has reduced due to the rebasing. But I guess they just want to see how things unfold before they begin to cut rates. Because ultimately, right, they want to have like a positive, they want investors to have like a positive return on their investments. And I think other thing that can make them begin to cut rates is if you are seeing a slowdown in the economy or a decline in the economy, um, they might want to cut rates to stimulate the economy to support growth. That is not likely to be seen, even though we expect growth to be sort of maybe plateaued or maybe come down a bit from where it closed in 2024. But so if there's a decline in the economy and they need to stimulate or support growth, that might make them to cut rates. Also, if we see Naira strengthen significantly and appreciate significantly, they might want to sort of cut rates. Well, we've seen a considerable appreciation in the Naira. We've seen external reserve as well, healthy position, comfortable level as well. So really, there's not so much aggressive demand for maybe foreign inflows are expensive. Because if you look at the trajectory, they've been doing a lot of OMO issuances, which have supported the growth in the external reserve. But if you see a strengthened external reserve, strengthened oil price as well, that might be some consideration for cutting rates. Then, of course, debt sustainability. They might want to borrow cheap. Usually, government want to borrow cheap to either fund their budget deficits, and if they think that they are borrowing at an aggressive level or too high level, they might consider cutting rates just to ensure that they are borrowing at a lower level that wouldn't be affecting their repayments or their cost of fund or their refinancing cost. Another reason might be we are seeing sort of a decline in yields, either the treasury market or secondary market yields, for instance. They might just want to bring the monetary policy rate closer to where market yields are. So those are some of the factors that might make them to begin cutting rates. However, at the next FPC meeting, do we see them cut rates? I don't think so. At the next FPC meeting, maybe the meeting after that, they might just want to see proceedings of things at next FPC meeting, and afterwards they might sort of now decide whether they want to cut rates or not. But we don't foresee any rate cuts in H1.
Okay, all right. Thank you so much, GB, for that. So Charlie, I'll come to you next, right? And I want us to talk about the EFMs, that's the electronic foreign exchange matching system that was introduced by the CBN for trading FX. What challenges do you think still exist with that platform?
Yeah, I mean, I've kind of touched on this already, and I think one thing to bear in mind is that this new system is incredibly positive for Nigeria. It's a step in the right direction for sure towards this more transparent market. Now, some of the challenges in my mind are essentially it's only the authorized dealer banks who can access EMS and accumulating another parallel market because they're quoting away from BMatch. And that's not entirely true. Maybe I framed it in the wrong context, because if you take something like, I don't know, listed equity in the US, there will be an order book for trading, I don't know, Ford shares in the S&P in the US. But if you bring up someone like JP Morgan and ask for a quote and a million forward shares, they would probably give you a price, and then they might work that into the into the S&P exchange and unwind the position that way. And it's something that's similar that's going on in the NAFM at the moment with the BMatch system. The only slight downside with that idea is it seems like a lot of the liquidity that's being quoted by local banks at the moment is being done in this sort of, I guess, OTC fashion. And it's leaving the BMatch order book relatively thin. And certainly Nigeria isn't the only economy who's going through this at the moment. I know Kenya is very similar. Kenya they use a very similar system using BMatch, and the order book there is pretty thin as well. So I guess a good step would be for other market participants, not just local banks or authorized dealer banks, to participate in BMatch. So off the top of my head, like IMTOs would be a clear opportunity to inject some liquidity directly into the order book. I guess requiring local banks or authorized dealer banks who are quoting these bigger ticket sizes away from BMatch, requiring them to unwind that position directly into BMatch and not allowing them to do natural flow. Is that a positive step? Maybe, but it might be a step too far, because if you have natural flow, there's no need to put it through the exchange again. In something like equities, you wouldn't have to do that. So maybe that's probably a little bit too far. But ultimately, increasing the liquidity in the BMatch order book is probably priority number one, and doing that by allowing more people to participate directly, like IMTOs, is a very easy thing, I would have said, for the CBN to do, I guess. And then the only other factor is looking at the Form M, Form A infrastructure. You've made these big steps with the electronic match system to get everything very quick and very transparent, very liquid, but you still have this somewhat archaic process of requesting a Form M or Form A that could take 2 weeks to generate. And either that process needs to be sped up, the red tape needs to be reduced, or the process that local banks needs to be done quickly so people can access the liquidity, or at least put their order into the BMatch system a lot faster. That would be a good step. Or maybe coming up with a completely different system from scratch, away from Form M, Form A, stop various corporates and other not individuals, but other market participants from being, I guess, on the outside looking in, and actually let them participate. I think all these moves are just little changes that can be made quite quickly that can increase the liquidity within the matching system. And ultimately, if you have more liquidity on both sides, you have a more stable market. And if you have a more stable market, that's going to give confidence to foreign investors to jump into Nigeria, because, like I said, the 5% moves in both markets that we've seen occasionally over the last 12 months or so, even if it's in a positive direction, it doesn't inspire confidence. If we can get more liquidity in the matching system, get it more stable and less volatile, get it a little bit more predictable, it can only be a long-term positive for Nigeria, in my mind.
Okay. Thank you so much, Charlie, for throwing more light on how the platform can base on the challenges that still exist with them. So Arnold, I want to come to you now, and I want us to consider the external policies that can affect the trajectory of Nigerian Naira. And my question to you is, let's focus basically on the US. How does Trump's policies affect the trajectory of the Nigerian Naira?
Okay, so when it comes to Nigerian Naira trajectory, I'll look at short term and long term, and I'll tell you why. So let's look at Trump and Trump, America First, Make America Great 2.0, aggressive tariffs, 25% blanket taxes on imports. So, I mean, it looks like someone's taking a look at the trade deficits, the US trade deficits, and realized that $1.2 trillion is too much. So what do we need to do? We need to reduce imports and increase exports. So one of the best ways to reduce imports or discourage imports is by slapping tariffs on imports. And then another way to reduce exports is by making your currency weaker. So, vocally say you want a weaker dollar and put some pressure on your central bank to reduce your interest rates to get your dollar weaker. And that's what's going on in America. So that seems to be the policy to a degree going on through the US. On the short term, it looks good because a weaker dollar is good for us. And we've seen it play out this year. You've seen there's an index before the DXY, which is the dollar versus a basket of American trading partners. We've seen it weaken to about 3.8% or 4% this year. So capital flow wise is wonderful, right? Because the dollar's weaker, so you get emerging markets. Dollar's weaker, commodity prices are higher, so you get emerging markets countries, emerging market commodity export countries they get stronger currencies. They get good inflows, what we call foreign portfolio inflows, which is wonderful. And you can see that play out in Nigeria, right? So regardless of a few reforms that we've had locally help our currency strengthen and stabilize. We've also seen FPI come in, right? So we have attractive, our assets are cheap, right? So currency was cheap at 1.7. Foreign portfolio inflows, the capital flow came in this year, and we saw it go from 1.7 to 1.5, or maybe 1,490. We saw OMO yields were high, treasury bills high, 1-year treasury bills 25%. Equity market was cheap. We saw this inflow from foreign portfolio inflows, so it's been great for the currency. So in the short term, the policies are good for us because we've seen stability in the Naira. Now let's push it to the long term. The problem with aggressive tariffs, right, is it affects global demand, right? Global demand, global consumers get weaker, global growth gets weaker, global demand gets weaker, global growth gets weaker. What that means is a weaker global growth means lower oil prices, right? And also uncertainty also means lower oil prices. And if you look at oil, we've seen oil go up from about $70 a barrel from the beginning of this year to about $80 a barrel to sometime in January. But when all the tariffs and all the headaches started, we saw oil dip by 15%, 13-15%. So what this means is fundamentally, in my view, this plays out. So right now in the short term, you have capital inflows, wonderful, weaker dollar, wonderful. When this lower oil price and lower oil, slower global, or when this higher tariffs kick in and affects global growth, and then affects consumer demand, and then affects oil prices, Nigeria is oil prices and oil production. I don't need to tell anyone about our oil production problems, and then oil price problems coming in as higher tariffs kick in. So what it means for us is shorter term, my trajectory is short term, we're good, stable currency. When the fundamentals start kicking in on the long term, and we see oil prices go lower, we might see a weaker Naira.
Well, thank you so much, Arnold, for that broad overview of the topic. So, I mean, what an enlightening and thought-provoking discussion that we've had so far. And I want to say a huge thank you to our esteemed panelists, Adegola, Arnold, and Charlie, for sharing their expertise and basically shedding light on the complexities of Nigerian FX landscape, the investment strategies, as well as our economic outlook. From the conversation we've had so far, we've explored the origins of the parallel markets, the outlook for the USD and Naira, the role of USD-based mutual funds and hedging FX risk, as well as CBN policy direction. So they've also helped us to tackle the impact of crude oil prices, global politics, as well as the best way for investors to navigate the current volatility. So from all of the discussion that I've been having so far, I think one of the key takeaway is that staying ahead of this ever-evolving environment requires strategic diversification. It requires us to be informed, to make informed decision-making, as well as for us to keep a keen eye on both the local and global economic shifts. So, I mean, like they said also, while the challenges remain, there are clear opportunities for businesses and investors who position themselves wisely, and that's something that Cordros Asset Management can help businesses and investors to navigate. All right, so we'll be moving on now to our audience. So it's time to involve our audience, and I hope you've all been sending in your questions. I'm checking the chat box now. So, but if you have not, this is a great time to do so we can have our panelists take your question. So I have a question here that says, would fiscal dominance be a challenge to monetary stability, particularly fixed income yields in 2025? Hannah, do you want to take this question?
Sure. Fiscal versus monetary is something that we've been battling with here as well. Just trying to get our heads around it. Monetary is central bank, fiscal is Ministry of Finance. You could even push DMOs towards. So I think fiscally, the DMO has to watch its cost of borrowing. Yeah, so I think, I mean, the short answer is yes. I think at some point we start to worry about our fiscal deficit. To bond prices so it's a tough one. I'll be honest, it's a tough one. So the question, will fiscal take dominance over monetary in the bond markets? Yes, it will. I think the DMO has to watch its cost of borrowing. I think that, I mean, you can see it in the bond auction that came in on Monday. We all are used to 5-year, 7-year, 10-year bond yields coming in at 20-something%, DMO coming in at that high cost of borrowing. I think at some point they looked at the books and realized that this is not sustainable and started to bring the auction came in at 19 or so percent, so just below 20%. I think it shocked most of the markets because we all thought that, okay, the FPI inflow was the attraction, right? CBN have done what they need to do, FPI flow is the attraction, but then the DMO came in with, hold on a minute, we need to watch our cost of borrowing. So yes, I think that we're going to start seeing the play out on the fiscal side, regardless of whether the government needs to borrow what it needs to borrow, and regardless of whether the increase in borrowing means bond yields need to be attractive. I think at some point everyone asks themselves, hold on a minute, what are we paying for this attraction? So you can see it play out.
Okay, all right. Thank you so much. I'm sure the person that asked this question has already gotten the answer, so thank you so much. Charlie, I think you are best suited for this next question. And it says, do you think both markets can be harmonized, and how can they be harmonized if it's possible?
Can the two markets be harmonized? Yeah, absolutely. I mean, all they need to do is follow the similar sort of model that a developed market does. You just completely let the FX rate go free, and you reduce all the restrictions that may be in place to access NAFM liquidity. But I mean, as far as I'm concerned, and maybe I'm drawing on comments from Governor Cardoso from maybe 6 months ago, but I think their MO is still they are happy for the parallel market to sure that's the case. Anecdotally, I still think there's quite a lot that goes through the parallel market despite the increased dollar liquidity in the official. So in order to harmonize or unify markets, you would need to find a way to shift as much as, if not all of the dollar or the market liquidity away from parallel and into the official. That's without putting in restrictions, without releasing restrictions. That's probably going to be a challenge. I think you're still going to get a decent amount of FX volume going through the parallel market whilst you have these restrictions in place. So yes, it can be done. I don't think it will be. I don't think the CBN have an immediate aptitude. And if they did look to try and unify the two markets, I think they would need to have a lot of confidence that the majority, a lot of depreciation potentially in that scenario. So yeah, they would have to time it. They would have to time it pretty well if they're going to try and unify it. But I don't think it's going to happen, at least not this year.
All right, thank you so much, Charlie, for answering that question. As we proceed on, I'd like to crave the indulgence of our panelists to please try and keep the answers brief and concise as we're pressed for time. So my question, GB, from the audience is, I think this is, you are in the best position to take this. Any likelihood of FPIs returning to equities on the NGX this year?
Yeah, and I'll say maybe in trickles. Although a lot of the factors that would have been in return are already coming in place. Like I said, our exchange rate has been stable. And really, one reason why the level was because of that instability in the exchange rate. There was a lot of market confidence that had been eroded. So now we've seen
Yeah.
some stability, we've seen dollar liquidity in the markets, we've seen reserves grow at healthy levels. A lot of the things that were like bottleneck, the restrictions have been removed. So really the market is any major markets. So that might be what might cause a delay. But really looking at every other factor in terms of exchange rates, in terms of dollar liquidity, in terms of reserves, in terms of valuation, really we should start to see them in the market. And really they've played a significant role in our fixed income markets through OMOs and treasury bills, special OMOs, private OMOs and all that, which mean, of course, I don't have any issue playing our markets, but we now need to see them moving from maybe the fixed income market to the equity markets. So that will eventually happen, but in this year, it might not be a massive run, it might be in trickles. But as the global economy, the global atmosphere begins to stabilize, then we might see them coming, um, they might not rush in. But for this year, I think it's going to be in trickles because of a lot of the global factors that are within our control. And of course, they usually use oil price to also sort of measure Nigeria's riskiness. And of course, oil price has been sort of weakened in recent time, which of course not too good a signal, but you'll agree that oil production has increased significantly in recent time as well. And so if we see a stabilized oil price, increase oil production, and every other factor that I've mentioned, begin to see them come in mass in our equity markets.
I just jump in for a comment on equities, by the way. It's only a quick one. Just anecdotally speaking, to a lot of hedge funds, say 5 years ago, there wasn't a lot of appetite to invest in any equity market, at least in emerging markets, really at all. It was very much preferred to go down the bond T-bill route in order to gain that exposure. However, I know in somewhere like Argentina, like the equities trade was actually probably the most profitable and biggest trade for those who invested in Argentina among the revival that happened over the last 12 months, rather than bonds and T-bills. So I would argue from an FP perspective, the appetite is there to gain exposure via equities. And yes, the NGX is obviously quite heavily weighted towards financial institutions, but it's certainly an investment route that a lot of foreign investors would entertain beyond just T-bills and
Thank you.
All right, thank you so much, Charlie and GB. So this next question, Arnold, I think you should answer it. Is there any real correlation between the MPC rate and the FX exchange rate?
So there should be, economically speaking, from the economics that we all learned in school and we all read around the world, that high interest rates from currency and vice versa. I guess on the one hand you can see it, right? So we went into an extreme hawkish environment that came in, and then one thing led to another, and then you saw strengthening in the currency and also inflation, a disinflationary environment. So yes, there should be, but you also know that. MPR, monetary policy, is not the only tool that the central bank is using to tighten, to stabilize the currency and tighten liquidity. But it's one of the tools. So one could argue that yes, there is some correlation between the MPR, monetary policy rate, and the more stable currency.
Okay, all right. Thank you so much, Arnold, for that. So, Charlie, I think you should answer this question. Given the historical intervention by the CBN to inject US liquidity, do you think the current balance in the USD markets is sustainable, or are we likely to see another round of devaluation and parallel market divergence?
It's a good point. I mean, it's no secret that the CBN have been intervening directly in the market, and there are some may argue it's been pretty ineffective. There's others that argue that it's been absolutely necessary in order to keep everything under control. Anecdotally, there was a drop in the efficient market. I think it was back in December. The CBN were actually at their dollars, something we've seen the likes of the Central Bank of Kenya do as well. And any sort of drop, say like they try and quote unquote stabilize the drop, even though it's in a positive direction, by buying up dollars. So it's long term. Clearly, it can't keep continuing, especially that continuing to supply dollars into the market. It's only a matter of time for reserve data really starts looking a bit shabby. But in the short to medium term, I think it's fine in the scale that they're doing, and I think it's I wouldn't say necessary either. I think it's a necessary practice in order to inspire confidence in the market and keep it stoked. But at some point, there's going to have to be a move to wean them off any sort of dollar supply from the CBN. I think we're heading in that direction. I think that's a completely likely scenario in the short to medium term. Will we see another round of devaluation, parallel divergence? I would say no in terms of devaluation. I think the X environment at the moment, again, anecdotally from foreign investors, is everything is cheap enough, if you like. I don't think there's going to be and there seems to be less inflationary pressure on the rate. Divergence or convergence to zero is going to be long term. It's just going to fluctuate in a window until we start seeing even more dollar liquidity in market, where we should start seeing it tighten up further.
Hi, Charlie, for that. So I think the last question we have is about infrastructure growth fund. GB, do you see Quadra setting up an infrastructure growth fund to take advantage of the new drive by FGN and other private entities?
Okay. Yeah, I'm sure that was from one of the listeners. Yeah, definitely. It's something we are looking at, and I would say it's a no-brainer. So in Nigeria, definitely there's huge infrastructure deficits, housing deficits, and government really cannot fund all these, a lot of these things. So private capital needs to go into these things, long-term private capital, either via debt or equity. Yeah, so it's something that we are considering, and very soon we have our infrastructure growth fund or private debt fund. Yeah, definitely.
Okay, all right. Thank you so much. I think that's all the questions that we got from the audience. So as we wrap up, I would like to thank you so much for our panelists as well for doing justice to the questions, and I hope everybody was able to get the answer to the questions that they asked. Assets management to speak on one of our key products, which is the Quadra's Dollar Fund. Arnold, over to you, please.
Okay, sure. Thank you, Bisola. I mean, everything that we've spoken about and everything that we've mentioned, one of there are a couple of there are some good ways to play a weak and Naira environment or stable Naira environment. But one thing we can all argue that regardless of how stable the Naira is, or we can all agree rather, that regardless of how stable the Naira is, we all know that a stable Naira is a steady depreciation. If you look at Naira from the 80s, the decade that I was born to where it is now, it's the value, right? So whether it's use the word depreciated, which is slow depreciation rather, or the value, which is aggressive. So a combination of those has brought us to where we are now against the dollar. So it is almost a no-brainer to say one needs to be able to hedge their position in Nigeria. A weaker Naira or depreciating Naira it causes the inflation, first of all, right? So you need to be able to hedge against inflation, which is alternative products that we spoke about, that Bonham spoke about, which is alternatives and infrastructure. That's a good inflation hedge. Equity is a good inflation hedge, or the best inflation hedge, or the best currency hedge rather, is a dollar position. Now, do you want to hold your dollars or don't? Because there's still dollar inflation. So $1 today is still not $1 tomorrow because the US dollar, the US has inflation. So you want to hold dollar assets. And holding dollar assets means an asset that can hedge you against dollar inflation. So one of our products that we have is the Quadras Dollar Fund. The Quadras Dollar Fund is a dollar denominated fixed income fund that gives you that low risk but a high coupon, a dollar coupon, that dollar cash inflow that comes in and gives you exposure to the Eurobond market. Now, normally without the dollar fund, it is quite expensive for a retail investor or any investor to get involved in Eurobonds. It's normally $200,000, but the Quadras Dollar Fund breaks it down into units. So you have exposure, like we spoke earlier, to Eurobond assets, not just in Nigeria, but across the continent as well. And also, there are some there's some companies that actually have corporate Eurobonds. So that's really what the Dollar Fund is, really. It's a low risk dollar or Naira hedge assets or low risk Naira hedge mutual fund that allows you to earn USD, allows you to protect your Naira income. And normally, when I speak to investors about the dollar fund, I always say, you want to allocate 20 to 30 or to 40% of your investments in dollars, and there's no better place than the Quadras Dollar Fund.
All right, thank you so much, Arnold, for speaking about the product. And so far, we've had a very impactful day, and it's been a very insightful session as well. But before we close, I just want to do like a quick recap of what our speakers have spoken about and some of the takeaways from today's webinar. So please confirm you can hear me.
I can hear you, so.
Oh, okay. Thank you so much. It was showing me that I had network issue. All right. So, the discussion today has explored how the parallel markets for USD emerged and why it continues to play a key role despite efforts at market unification. We also looked at the 2025 outlook for the USD Naira exchange rates was analyzed deeply by our speakers with insights into key economic drivers, including inflation control, monetary policies, as well as foreign reserves. We also looked at the CPN balancing, inflation control, and economic growth. We examined what could trigger a shift towards a rate cut and the potential impacts on our investors' confidence. We spoke about the firm's aims to streamline the FX transactions, but the challenges such as liquidity gaps as well as the market inefficiencies still persist. We looked at from the investors looking to urge against currency depreciation, a diversified portfolio of Naira-denominated assets as well as foreign investment was discussed about. We also spoke a bit about the oil price fluctuation that continues to play a key role in influencing our foreign investor appetite that sort of underscores the need for businesses to remain agile in their strategies. And on the final note, we look at the global economic policy, specifically the US, where we discuss potential factors affecting our Nigeria's financial landscape. And of course, Quadras Asset Management will remain committed to help our clients navigate the complexity of this financial market. So we basically want to encourage everyone to continue the conversation beyond today. And for more information on how asset management can help you and basically, make you hedge against all this that I was speaking about, please feel free to reach out to us using the details on the screen. You can reach out to us on using these contact details, and somebody on our team will get your necessary information or details or inquiries that you need to use. So a huge thank you to our esteemed speakers once again. Thank you, Adigbola, Aino, Charlie Bird, Arnold Dublin Green, for your valuable insights, and to our audience as well, because this webinar would have been impossible without your presence. And thank you so much for your time as well as your engagement. We look forward to seeing you at our future sessions. We hope it was as impactful and as knowledgeable as you expected it to be. So until next time, stay informed, stay strategic, and of course, try and stay ahead of Naira. Thank you all so much, and do enjoy the rest of your day.
Thank you, everyone. Thanks, Bisola.
Thanks, Bisola. Thank you.
Thank you, everyone. Thank you, Bisola.